Hello everyone, this is Glenn Neely. I'm going to be teaching a short class on NEOWAVE and its scientific approach to market analysis and how it differentiates from standard or orthodox Elliott wave theory. The session has to be only about 30 minutes because if we go too long, then we can't upload the file to YouTube because the files get too large. So I'm going to try to keep this down to 30 minutes. A NEOWAVE is a vastly more complex form of wave analysis with many more rules and concepts than orthodox Elliott wave, but it also allows you a much greater level of confidence and certainty and specificity when it comes to prediction, whereas Elliott wave just generally tells you the market's going up or down, or when it might be topping or when it might be bottoming, but with no concept of time, no concept of the complexity of patterns, frequently not specific duration, price coverage of movement. So there's a lot of unknowns when it comes to orthodox Elliott wave that NEOWAVE helps you explain and rein in and control. And so the primary attributes of NEOWAVE that's separated from orthodox Elliott wave is in the area of complexity management, time predictions, and the concept of self-confirmation. If a market theory, at least under wave theory, if it doesn't have some form of self-confirmation, then it means your entire analysis process is just your opinion, and it can be against someone else's opinion. Everybody has different opinions, and so nobody knows who's right. So the concept of confirmation is probably the strongest differentiator between orthodox Elliott wave and NEOWAVE, in that the market's own behavior decides whether you're correct in your analysis or not, that it moves it out of the realm of opinion and into the realm of a scientific kind of process. So there's a lot of logic and a quasi-connection to vector physics that occurs with NEOWAVE, and a great deal of time price containment for every single pattern that you're looking at. So let's move on to the next page and just go over a little bit of the overview of the concepts, and then we can get into some actual application in real time. Not sure why the word NEOWAVE here went on a separate line. Let me go ahead and fix that. So the process of analysis, unlike what you see many people do with Elliott wave, is that you always want to begin your analysis from the largest time frame possible. Frequently, this is monthly charts, but because I have a programmer who works for me, I can hire him to construct different time frames above and beyond just monthly charts. And the reason I did that is because the monthly charts on the S&P, which is one of my primary markets, has gotten so complicated if you go back to 1982 that it becomes an almost unmanageable level of complexity. And you'll learn over time with NEOWAVE that complexity management is very important. You have too much detail in a chart, and it allows you too much flexibility in what you're going to determine. And so again, it moves the analysis away from objective, logical, analytical science and into more of an opinion-based process. So it's very important that you control complexity on all charts at all times so that you're keeping your analysis objective and not subjective. So because I have this programmer who can do this work for me, I had him take Excel and construct from monthly data 6 monthly charts and 2.5-year charts. So even the 6 monthly charts were getting a little too complicated. So I had to move to 2.5-year timeframes to really simplify what I was looking at going back to 1982, which is around the time the S&P became available, so that I could actually see a controllable, simplified version of all the price action back to 1982. And I'll show you those charts in a minute. When you get these charts constructed on your own or using a service, you're going to want to first look for the largest, fastest price move on a chart, because the largest, fastest move on a chart always occurs in the direction of the trend. There's no exceptions to that. I've never seen an exception to that in 35 years. So the largest, fastest move on the chart will always be wave 1, wave 3, or wave 5 of a impulsive pattern, or it'll be wave A, wave C, or wave E of a corrective pattern. So that's the reason you're wanting to find these largest, fastest moves. And once you find them, then the next thing you can do is quickly decide, is that move completely retraced, or is it retraced less than 61%? And if the largest, fastest move on the chart is retraced less than 61%, and then the trend continues, the odds are pretty good you're dealing either with an impulsive pattern or a zigzag. If it's retraced more than 61%, the chances are extremely high you're dealing with a correction. There's an outside chance you'd be dealing with what I call a terminal pattern, but 9 times out of 10 it would just be an ABC correction. Now, when I talk about controlling complexity, what I'm talking about is managing the number of visible monowaves on your chart. If you happen to have a copy of my book, Mastering Elliott Wave, handy, you can go to chapter 3, and it starts to show examples of what monowaves are. So if you go to chapter 3, page 15, that's 3-15, it discusses the concepts of monowaves and what constitutes, a wave on a chart. And it separates every single move up and down on a properly drawn wave chart as a monowave. So you don't want to have less than about 13 of those on any chart that you're trying to analyze and arrive at a conclusion. And you don't want to have more than about 55. If you have more than 55, it becomes too complicated to come up with objective scenarios, and it starts to move into the realm of subjectivity. And if you have less than 13, then there's really generally not enough information to be sure that what you're looking at is going to actually end up being the pattern that you think it is. So you want to control your complexity between about 13 and 55 monowaves. This means that if you have a chart that's a lot more complicated than that, then you're going to want to move to a higher time frame. So if I have a monthly chart that has a few hundred monowaves, I'm going to want to go to a 6-monthly chart where we're only plotting the highs and lows for every 6 months. And then that gets the complexity hopefully down to between 13 and 55 monowaves. If you're looking at a chart that's maybe 8 monowaves, and that's an indication you need to move to a lower time frame to increase the complexity and get the complexity to fall somewhere between the 13 to 55 monowaves. Now, these monowaves are created by plotting the highs and lows, and it should be done with cache data because cache data doesn't expire, so you don't have to worry about redrawing the charts, and cache data doesn't provide or doesn't cause degradation of data over time. If you're following a futures chart, it has an expiration date, it has a start date, and over time it slowly deteriorates. Generally, most of them do. Slowly deteriorates in value, so you have distortion of wave structure. You always want to use cache charts. You want to plot the highs and lows in the order they occurred in real time. Preferably, you want to get intraday charts of the price action so you can figure out whether the high or the low occurred first on any particular day. I don't really recommend going on any time frame below daily. It's generally just a waste of time. It's too much work for too little reward. So I only go to daily charts. I figure out the high and low, which came first. I plot the low first, the high second, or the high second and the low, the high first and the low second. And then you connect those two with a straight line. And then when you go to the next day, if the low occurred first, then you connect that to the previous day's high or low. And if the high occurred first, you connect that to the previous day's high or low. And then just keep connecting each high and low in the order they occurred in real time. And you'll see what this looks like in a minute when I get to real-time charts. And every rule that's mentioned in my book of Mastering Elliott Wave, that's what the NEW stands for, Mastering Elliott Wave, which you can get online through Amazon.com or iTunes or Kindle. or you can go to my website, neowave.com, click on the education section, and you can find links to my book there where you can order it. So every pattern under wave theory has a slight different set of rules. So this is what makes NEOWAVE a lot more complicated than Elliott Wave, because there's a lot more rules involved, but those rules specifically allow you to precisely predict the kind of behavior every single pattern should have, what kind of relationships, what kind of channeling, the duration, the complexity, all these things can be determined, which is not possible with orthodox Elliott Wave. And then getting to the most important concept that I mentioned to you earlier of NEOWAVE is this concept of confirmation. That when you've determined that a certain pattern is forming on a chart, say you decide that a flat is forming or a zigzag or a five-wave move, there's very specific, excuse me, there's very specific behavior that you have to see occur on the chart after the pattern is over to confirm that what you thought was a flat or a zigzag or a five-wave move actually turned out to be what you thought it was. And that's dictated by confirmation rules, and it requires a very specific kind of price, time, and complexity behavior. The minute a pattern is over, there's things that need to happen to confirm that what you thought was a flat or a zigzag or a five-wave move actually was. So let's go ahead and take a look at some charts. And I'm going to begin with a short-term chart here just to, I don't want to start with that one. I'm going to have a chart complicated enough. Okay, there you go. Here's a long-term chart. I'm trying to find the best example here. Okay, this looks like a good one. Okay, so here's a long-term chart of the S&P. This goes back to 1982, and it shows a large number of monowaves on this chart. And it was because of this that I wanted to go to the next higher time frame. So this is actually, let's see, I think this is actually the highs and lows. Let me just double check on this. I think this is the highs and lows of every 6 months. So yeah, this is a 6 monthly chart. So even the 6 month highs and lows have gotten where there's too much complexity, and I had to create a 2.5 year chart of this data. Looking at this chart, you can see if you were to count every single up and down move, it's going to exceed 55. Obviously, it's way more than 13. So it's moving into the realm of complexity that's unmanageable. And you want to reduce that complexity so that you can more properly apply the rules and concepts in my book and do it objectively instead of subjectively. One little thing I wanted to point out on this chart, which sort of separates me from virtually the entire Elliott Wave field, is that back in 1988, I wrote an article in Cycles magazine, which was written with the Dow right here around 1900, and the S&P was around 240. But I predicted that the Dow Jones would never break the low of 1987 ever again, and that the Dow would eventually reach or exceed 100,000 by the year 2065. This is about a 75-year forecast. It was made right at a time when virtually every Elliott Wave analyst in the world believed that the stock market was crashing and we were going into a Great Depression, and that it was going to break below the 1982 low. So I stood alone pretty much as the only analyst in the world, not just wave analyst, but only forecaster in the world, saying that the stock market had bottomed here and that we were getting ready, or we were going to continue this bull market that would go on for another 75 years, and the Dow would eventually exceed 100,000, which is also about 10,000 in the S&P. We were only at about 240 at the time, as you can see from the value there, only about 240 in the S&P. So to call for a 10,000 S&P at that time was, in most people's minds, complete absurdity. And I presented this concept at a Cycles magazine week or monthly presentation, and I was practically laughed out of the room. The minute I said that I believed the Dow was going to go to 100,000 in the next 70 years, I mean, people just thought it was the craziest thing they'd ever heard. So this is just one example of how well how well NEOWAVE theory works in relation to orthodox Elliott wave, which was hyper bearish and has been predominantly bearish for the last 30 years. Most Elliott wave analysts have called for virtually every single high that we see here on this chart for the last 30 years as the end of the bull market, the end of the world, the end of the US, and of course the market just keeps going up. Okay, so to simplify this picture, I had to have my programmer create a 6.5 month chart, which gets us to this scenario here. This is a more elaborate version, but this is, I'm going to move these out of the way for a minute. This is the big picture, and you can see how it gets us into that 13 to 55 monowave complexity zone. So you can see it's not too complicated, it's not too simple. So it begins to allow us to do some wave analysis. So, excuse me. So what are the things we want to look for? When we're looking at a chart, we want to make sure that we're locating the largest, fastest move on the chart, which we then know based on our discussion earlier, the largest, fastest move on a chart will be wave 1, 3, or 5 of an impulsive pattern, or wave A, C, or E of a corrective pattern. So when we look at this chart, it's very obvious where the largest, fastest move on the chart is. That would be this decline right here. So that is the largest, fastest move in the S&P in the last 20, 30 years. So that has to either be wave 1, 3, or 5 of an impulsive pattern, or wave A, C, or E of a corrective pattern. If it's completely retraced, it has to be wave A, C, or E of a corrective pattern. So we have multiple choices here. I don't know if I have a different scenario. Let's see. Yeah, we have 2 choices here. So we have the possibility that, sorry, I'm going to have to move that back. I'm going to try to grab this and move it away. This is some of the analysis that I've done with some of the people who take my class. So I'm just trying to get the charts back to a sort of a beginner's state so we can talk about it without any preconceived notions of anything. So if we work with this decline as the start, and I'm going to check this other chart. So we have 2 scenarios. One that this is wave C of an ABC, or one that this is wave A of an ABC. It can't be wave E because this rally is slower than this decline right here, and I'll get into that after a while. But this can only be wave A or wave C of a correction. Now this high, I assume, is wave 3 based on super long-term market analysis, and this low is wave 2, but it really doesn't matter what we call this wave. We just know it's the end of something, and we know this is the beginning of something. And that same concept applies to this particular high if we assume that the correction began here, and this is wave A, and this is wave B, and this is wave C. So those are the 2 choices, that it's the C wave or it's the A wave. We take the idea that it's the A wave, then you can see that the B wave is getting extremely large, and it's drifting with the trend almost to the point where it's getting uncomfortable, you could say, because there's no clear explanation for it to be so large at this time. So the size and complexity of the B wave does raise some questions on whether this is plausible. It could work, but when we get into some other analysis, you'll see it probably doesn't work. But this is one possibility, and this is the other. So that's the most important thing to begin with, is that this large, fast move is going to be the A wave or the C wave of something. So if we try to make it the C wave of something, the rally is now too slow to be the start of a new bull market. Now, most people would just, call this the end of possibly wave 4. So I'm just, for simplicity's sake, I'm going to call this wave 3. And most people would just immediately assume this is wave 4 and now we're in wave 5. But due to the concepts of confirmation and other things, this can't be the start of a 5th wave. And first reason is that when you finish a correction, and this concept is discussed in chapter 6 in my book. So if you go to chapter 6, page 2, actually, let's move on because we're dealing with a correction. So it's 6-3, 4, and 5. And it talks about the conclusion of a flat. If you look at 6-5, it shows an ABC, and it shows the behavior you need to see after that ABC pattern is over. So if we follow the rules in the book, we would draw a channel across the top of wave A and the top of wave B. So here's the top of A, here's the top of B, and I'm going to copy this and move it down to here. So most orthodox Elliott wave analysts would just say it's an ABC flat and that's the end of it. But you'll notice that it doesn't follow the rules of confirmation. The rules of confirmation state that when a correction is over, in this case the C wave, that the retracement of that C wave has to occur in the same amount of time or less as the C wave took to form. So if we measure the time of wave C, we can see that the retracement of that C wave took much, much longer to get back above the top of the C wave than the C wave itself took to form. You can see it took more than 3 times the time to exceed this high. It also took 3 times the time to exceed the channel. So there's 2 types of confirmation that occur in a pattern. Remember, this confirmation process is where the market tests your theory of the structure, whatever that structure is that you believe is unfolding, and it's a way of testing to see if your analysis was correct, because the post-pattern behavior has to follow very specific rules to confirm that it's finished something. Now, why is that the case? That's the case because when you're beginning a trend of a larger degree, that movement, the smaller movement in that bigger trend, is moving with the trend, not against the trend. In this particular case, this move right here, the B wave, this is a counter trend move that is inside of a downtrend. So the trend at this point is wave 4 going down. The B wave is a counter trend move inside of that decline. And so when you're beginning a new future move, it's important that the market behaves, quicker, faster, and further than previous patterns inside of the previous formation. So in this particular case, the rally or the movement after wave 4 was larger and faster than the B wave itself. So that was at least allowing for the possibility you started a new trend, but there's additional rules of confirmation that apply to the last move of the pattern. So it has to be bigger and faster than this, but it also has to be bigger and faster than the very last move of the pattern, because this is a down move of a correction. This is the up move of an impulsive pattern. It's sort of like the difference between swimming in the direction of a river or swimming against a river. So this is swimming against the river, so it's slower and choppier. This is swimming with the river, but the minute that it's over, you're now beginning a bigger uptrend and everything is going with that trend. So the first move needs to be bigger and faster than the last move of the previous decline. And I know this to be true from 35 years. I've never seen an exception to this rule. It is just the way markets behave. So when the post C wave rally turned out to be slower and smaller than the C wave itself, that was a problem for the confirmation of the end of this ABC. It doesn't mean this can't be a C wave, but it means it can't be the end of wave 4. It can't be the end of a flat. So that means we're dealing with something more unusual and more complicated. So if this is not the end of wave C, then it means we have to be in wave D, because the D wave of a pattern has to follow a C wave if the C wave isn't the end of the pattern. You could have an X wave, but X waves follow certain rules that this pattern so far is not adhering to, and the confirmation process still wasn't properly achieved. Even if you're in an X wave, you still will retrace the C wave in less time than the C wave took to form, and you'll get to this 0B trend line in less time than the C wave took to form, as long as this is the end of wave C and the end of a flat. So since it took too much time to exceed the 0B trend line, and the C wave, the post C wave rally was too small and too time consuming, we know that the rally after that C wave has to be a D wave. So if it's a D wave, when you're dealing with triangles or any other more complicated pattern, you're going to want to draw a channel across the B wave and the D wave, and then that has to be followed at least by a future E wave. Okay, now we don't know exactly what kind of triangle we're in at this moment, but when you have a D wave, you have to have an E wave, which means you have to at least have a triangle. It could be more complicated than that, but a triangle would be the first assumption. Now, when you're doing channeling with a triangle, there's multiple possibilities depending on the triangle you're in, but at the very least, this would be the minimum potential for the E wave if it's going to be what's called a neutral triangle. Now, most people know what neutral triangles are. The neutral triangles are patterns in which the middle leg is the largest and generally the most violent wave. So in this case, wave C is larger and more violent than wave A. And in all triangles, B waves need to alternate with D waves. You can see the D wave is very complicated and time consuming. The B wave is smaller and less complicated. The D wave probably takes about twice the time of wave B. They share some of the same price range. So this price range right here is covered partially by the D wave, and of course it keeps going up. So at the very least, if this is a triangle, the A wave and the E wave should be somewhat similar. The E wave could be as little as 61% and as much as 161% of wave A. If it's 161%, then we're in an expanding triangle. If it's equal to wave A, then we're in a neutral triangle. If it's smaller than wave A, then we're in a neutral triangle. There's no chance of a contracting triangle because wave C is bigger than wave A. So that means that we're looking for this future movement. I'm going to copy this and use this here. Looking for a future move at the very least that's similar to wave A and could be as little as 61% of wave A. That starts somewhere, sometime soon. Remember, this is a 2.5-year chart, so sometime soon could be 2 years from now. But we're looking for a move down at least into this area and possibly where it's equal to wave A, which would be a lot further down. But I'm going to make it at least to this point here, and this would be the point at which wave 4 could then finish. Now, if this is the end of wave 4, what are we going to want to see? We're going to want to see a move larger and faster than the biggest counter trend move inside of this triangle. So the future move would have to be bigger and faster than the D wave of the triangle, because remember, this is like swimming against the river. This pattern is swimming against the downtrend. The trend is down. That's where all the most violent movement is occurring. The slower, choppier, more time-consuming moves are going up. That's the counter trend. So when we begin the downtrend, it's going to be bigger and faster and is similar to these drops. And when all of this is over, when the fourth wave is finished, then the next move has to be bigger and faster than this D wave, and it's going to have to retrace the E wave itself faster than the E wave took to form. So it'll be something like that, where this is slower and smaller, and the future move will be faster and larger, and it'll probably go above this channel very quickly. So this is probably 2 to 4 years away from where this decline will take place, and the market, will begin the E wave of wave 4. And when that's over, then we should begin what will be the largest, fastest bull market of all time. So just like I said back in 1988, back at this point here, where most people didn't believe me about the low in 1987 being the lowest point that I would see for the rest of my life. This easily will be the lowest point I'll see for the rest of my life. And when this decline occurs, it'll probably finish somewhere in the 1600 range. Let me go back to the bigger chart. So when this decline happens, it'll probably happen somewhere around these old highs. So I'm going to just make this a little bit bigger just to relate it to what's most likely going to happen. It'll just probably retest, these old highs in here. And that would be the end of wave east. It means the channel will be something more like this. And that would be the conclusion of wave 4, followed by the start of wave 5, which will be the most amazing bull market in human history. And that should start probably around the year 2023, 2025, somewhere in there. And this bull market will be bigger and faster than the one from 1982 to the high in 2000. And it will be the most amazing period probably in human history as the entire world starts to become, high-tech, industrialized. The standard of living in all the third world countries will start to, be more like second and first world countries. So that's the really big picture. And it was based on finding the most violent movement on the chart and realizing that it's completely retraced. So it has to be an A wave, a C wave, or the E wave of something. Based on the evidence, most likely is that it's the C wave of a neutral triangle, and that we're currently in the D wave, and we're within a few months, maybe a year or less, of the conclusion of that D wave and the start of a 2 to 4 year bear market that'll come back toward the old highs. So this presentation gives you a good idea of what it's like to take my private classes or the group classes that we now offer, up to 25 people. And we obviously will take this kind of analysis and carry it down to lower and lower time frames. So if I were to take this scenario, let me see, I break it. This is a 2.5 year chart. So if we break it down to a 6 monthly chart, I don't know if I have that. Okay, so this is as low as it goes. So here's a 6 monthly chart, and it takes the same scenario we just went through, but it expands with more detail. So here's the same neutral triangle. We have wave A, wave B, and then based on evidence and the lack of proper recovery off this low, it indicates that wave C actually finished at a much higher low here. And that's where the market took off and started trending again. You can see from this low, it was very small bounce compared to the previous drop, and it took a long time for it to get back above this high, telling us that the downtrend didn't end here, but it ended later. So that's why the C wave is here. The D wave starts, and based on time relationships, we're now running out of time. So the D wave should finish sometime in the next 6 to 12 months, and we'll start that E wave decline. So this is a blow up of the 2.5 year scenario just from the high in 2000. And then as we go through the class analysis, we would then take this down to a monthly chart where we would not focus on this entire time frame, because this chart's starting to push up against the 55 mono wave limit, where it's going to get too complicated to analyze. So when we go to monthly charts, we have to focus just on this time frame here and try to figure out when this D wave is going to come to an end. So that gets us to this structure here. And of course, if you were taking the class, I would go through all the analysis of how this particular scenario came about. And then we're probably approaching the end of this pattern on a monthly chart and so forth. So the analysis is always carried down from the highest time frame to the smallest time frame. And that's always the process that you should begin. And you should never go to a lower time frame until the larger time frame is clear and you're sure of the possibilities that exist, and you narrow down your largest time frame to the one best scenario. And I explained to you how to do that also. And then once you have that one best scenario, you use that on the next lower time frame, where you structure everything based around that best scenario. And then on the lower time frame, you might have 2 or 3 possibilities that exist. I'll show you how to pick the best scenario on that time frame, and then take that one good scenario and carry it down to your weekly charts, and then carry that best weekly scenario down to your daily chart. So this way, it always maintains a continuous connection, logical and behavioral and outlook perspective will be maintained on all time frames by following this process, which is a process way more objective and scientific than you get with orthodox Elliott Wave. So I hope you enjoyed this very preliminary introduction to NEOWAVE, and that if you have any questions, you can always contact us. You can contact Magellan at neowave.com. That's Magellan, Magellan at neowave.com. So that's NEOWAVE and up here. Fix that E-Wave because it should be capitalized. And you can find out about the classes if you want to take the group classes. The group classes are the large group classes are now only $7.95, which is the cheapest I've ever offered classes before, because those are groups of about 15 to 25 people. We have the semi-private classes, which are just limited to 4, which gives you a lot more chance to ask questions and more interaction. Those are $2,900. The classes are for 3 months. They're taught once a week, and they last for an hour to hour and a half. And then there's still the private sessions that I offer, which is one-on-one, done in the same way, but it allows for a very high level of personal, direction and training. And those are $12,000 per person. So that's an overview of how the classes work and what makes NEOWAVE better than Elliott Wave, and hopefully you learned something, and hope you enjoyed it. Thanks a lot.